day friends, welcome to the CEC Gurukul lecture series on the topic of mutual fund. Friends, in the subject of fundamental of investment, today I will be talking of mutual funds. In India, the disposable income of the people is increasing. The middle class population and the rich class is increasing. So they are finding various ways of investing their surplus funds. In any country, the capital formation is must for the progress of the country. And one way of capital formation is that whatever you save, you invest in some productive asset class, and that will create income for you as an investor and for the investing company or investing organization. So in India, over a period of time, the mutual fund industry is expanding at a very fast rate. There are two ways of investing. One is called direct investing, other is called indirect investing. Direct investing, I mean to say that when any individual, corporate, whosoever is investing, directly purchase an asset. It may be financial asset, it may be any other asset in the form of gold or real estate or anything. So some asset is being bought by the individual, and over a period of time, the individual enjoys the benefit of the increase in the value of that asset, and if there is any income that is being generated by that asset, that is also being enjoyed by that person. But there are a lot of hassles in direct investing. The other way of investing is indirect investing. In the indirect way of investing, what an individual do is that whatever the surplus fund that individual has, that fund is being given to somebody. It may be trustee, it may be some corporate house, it may be anybody. And the trustee or that corporate house or whosoever is investing on the behalf of the different investors, they pool the funds of the different people and invest in some asset. And that is what mutual fund is all about. So what we do in the mutual fund is that investors who have a surplus funds, they give the money to some mutual fund house, and that mutual fund house creates a pool of resources. With this pool of resources, they invest in some asset class. It may be equity shares, it may be bond, it may be gold, or for that matter, any other asset. We say financial assets or financial securities or any other asset. And then the income that is being generated, this income is being shared by all the investors who have invested in that mutual fund. So what you do is that a pool of fund is being created. With this pool of fund, the mutual fund invest in the asset and the income is being generated. This is what mutual fund is. So a mutual fund is an investment vehicle made up of a pool of funds collected from many investors for the purpose of investing in securities. When I am saying using the word securities there, same as securities by and large, it may be equity shares or the bonds, right? Such as stock, bonds, money market instruments. Money market instruments means commercial paper, treasury bills, right? Gilt securities, government securities, and similar assets. So means mutual fund collects money and invest in these different type of securities. As per the SEBI is the regulator of the financial market in India. So SEBI Mutual Fund Regulation 1996 defines a mutual fund as a fund established in the form of a trust. What it means is that mutual fund is established in the form of a trust to raise money through the sale of units to the public or a section of the public under one or more schemes for investing in securities, including money market instruments. So this is basically what mutual funds means. So as I was saying in the beginning of this lecture, the mutual fund industry is expanding at a very fast rate in India. Today in India, almost 12 crore folios are there, means rather I would say the more than 12 crore folios. Folios means accounts, different accounts of the unit holders are there. And this account has doubled in a very short span of 2-3 years, right? What could not have been achieved in the last 10 years has been achieved in the last 2-3 years, right? So what it means is that mutual fund industry in India is expanding at a very fast rate. If you take the data of the January 2022, the asset management under management is 38.89 lakh crore. When I am saying AUM, normally known as AUM, asset under management, that is the mutual fund industry in India are managing the financial assets or assets worth 38.89 lakh crore. What it means is rupees 38, or I can say 39 trillion rupees worth of asset is being managed by the mutual fund industry. And friends, let me tell you that this asset, this holding of assets has increased 5.5 times in a short span of 10 years. For a country, 10 years is not a very long period of time, and in a 10-year period itself, this has increased more than 5.5 times. And as you can see these figures, the asset under management of the Indian mutual fund industry has grown from 6.5 lakh crore as on 31st March January 2012, means on 31st January 2012, the AUM, when I use the word AUM, means how much worth of asset the mutual fund industry was managing. So this figure was 6.59 lakh crore in the January 2012. This figure has come to 38.89 lakh crore in January 2022. It means in this period of 10 years has seen the expansion to the extent of 5.5 times increase in the asset management under mutual fund. This speaks volumes about the popularity of mutual fund industry in India. So this exhibits the expanding significance of mutual fund in India. So what are the features of, let me talk of the features of mutual funds. I mean, pool of funds. As I was saying, what is mutual fund? The different investors who want to invest in a mutual fund, they give their money to some trustee, or as I can say asset management, I will use the word trustee, to give to some trustee, and these trustees collects the money from investor and then invest. So it is a pool of funds. A large resources are being collected from different investors, which in turn the trustees invest the money. Professional management. One of the important feature, this point will come again and again in my course of discussion, that mutual fund, or the feature of the mutual fund, is that mutual funds are being managed by professional managers. They are the financial experts, they are the chartered accountants, they are the invested people who knows the pulse of the investment in the country and internationally, right? They have a good research team which makes the research on different assets, what is their strength, they see what is the growth potentialities of that asset, or that if I stick myself to equity shares and bonds, I will say each and every equity share is being analyzed thoroughly, and these professional managers manage the funds in such a manner so that it can give good returns to the investor. The objective of the mutual fund is to give the return which is higher than the return of the index. That is one of the barometer of increase in the equity. If I say about the equity, is the Sensex or the Nifty. Sensex is the index number of the Bombay Stock Exchange, BSE, and the Nifty is the index number of the National Stock Exchange, the two large and the most popular stock exchanges in the country, right? So their endeavor is, this professional management tries to give the return to its investor, a return which is higher than the return of the Sensex or the Nifty. Diversified portfolio. We always advocate that risk is being diversified, risk is being mitigated by diversifying your portfolio. Normally in the normal parlance say, don't put all your eggs in one basket. Why we say? Because when you diversify, when instead of buying one share, when you buy 10 different type of shares, 10 different companies, 10 different sectors, there is a likelihood that if one of the company doesn't perform well, the other company may perform better, right? So if one of the sector, like if supposing the textile sector is not performing well, probably the IT sector may be performing well, right? So you can diversify your portfolio. So the benefit of the feature of the mutual fund is that because they have large pool of resources at their disposal, normally they invest not in one particular type of asset, but they invest in different assets, or within the asset different type of equities, I would say, or if it is an equity fund. Indirect investment. See, I was saying in the beginning, there are two forms of investment. One is direct investment, where the investor directly purchase the shares or bonds or that asset. Other is the indirect investment. That is, the investor does not directly buy or sell that asset, but give his money or her money to somebody to invest on his or her behalf. So mutual fund is also indirect investment, because the mutual fund house, or I will say the trustee or the AMC, I will be talking of this thing in this course of my discussion, that they invest on behalf of their investors. So it is an indirect form of investment. Representative of investors. It is from the point of indirect investment. This also point comes that the feature of the mutual fund is that it is the representative of investors. Mutual fund house or mutual fund represent the different investors who have invested in that scheme, not a borrower. See, when you give money to the mutual fund house, you are not creating a debtor-creditor relationship, right? This relationship is not of a borrower or the creditor and the debtor, right? This relationship is that they are the trustee. The mutual fund house is a trustee of the investors, right? So they are not borrowers. They invest on your behalf, on behalf of the investing class, right? So you have entrusted the job of your investment to that mutual fund. So they are not a borrower. So these are some of the features of mutual funds. Why mutual fund? The question comes, why mutual funds? Because I and you as an individual, when we invest directly, there are certain risks involved, there are certain problems involved, there are certain aspects. We are not as professional as the people who are managing the mutual funds, right? Or we may not have that much time to make the research of investment, right? Or you and I may be busy in our own work, right? You are a student, you are busy in your studies. I'm a teacher, right? I'm busy in my own work. So we may not have the time to analyze each and every asset, each and every equity, each and every debt, right? So because of the shortage of time, because of the lack of expertise, because of various things, various problems involved, there are multiple risks involved in direct investing, right? So what we do is that if you invest directly, by and large, robust analysis is not done. When I'm saying robust analysis means research is not being done before investing. Individual investor have inability to diversify. See, supposing I as a middle class person can invest 10 lakh, 20 lakh, 50 lakh, 1 crore, 2 crore. But these mutual fund house collects the money in thousands of crores of rupees, right? So with this thousands of crores of rupees at their disposal, they can better diversify as compared to the individual. I as an investor, if I have 1 lakh rupees to invest, I can buy 4-5 different shares, equities, and that too in a very limited quantity. But the fund house, which has thousands of crores of rupees, can invest in different equities, right? So means they can diversify in a better manner as compared to the individual. Subject to misunderstanding, risk and other costs related to investment, right? Sometimes the individuals, when you invest directly, you are not able to foresee the risk involved in investing in that asset, right? Which professional managers, professional researchers can better understand. So there is a risk of individual investing. Knowledge of the updates and need to be alert all times, right? So we cannot update ourselves on a day-to-day basis because of limited time, limited resources at our disposal. We are all busy in our own work. So since we have limited time and energy to update ourselves, it is better to invest through mutual funds. So these are the various risks involved if you invest directly or by individual investing. So because of these risks involved, here comes the need of mutual funds. So I will put all these points which I talked about earlier in other way. That mutual fund houses has professional management, they have experts, they have research analysts, they are MBAs, they are finance experts, they are chartered accountants who are considered to be the financial experts, who are considered to be the technical experts of different industry, right? There may be engineers also who know the expertise, who have the expertise of the different industry. So in large mutual fund houses, there are different analysts of different industry who can understand the industry in a better manner. Suppose somebody is an analyst of textile industry, somebody is an analyst of steel industry, somebody is an analyst of the IT industry, somebody is an analyst of FMGC, fast moving consumer goods. So these different analysts analyze the industry, the equity shares which belongs to that industry, right? So they have the professional management, easy liquidity. The benefit of the mutual fund is these days in India, if today you want to take your money back, right? So you just get your units. Each investment which you make is called unit, and these units are normally divided on a small parts. So you can liquidate your money at any point of time. You can today, if you liquidate, after 2 days you will get your money in your account. Within 2 days you will get your money in your account. So there is a very easy liquidity. Diversification of risk, I have already spoken about. Return potential in the mutual fund, the return potential is very high, and the mutual fund houses always tries to give a better return as compared to the return which an individual can generate because of their expertise, because of their professionalism in investment, right? Well regulated. In India, fortunately, all mutual financial markets and including the mutual fund, they are well regulated by the regulator, that is SEBI. All these mutual fund houses, they are regulated by Securities and Exchange Board of India, and there are very strict rules which are to be strictly complied by the mutual fund houses. The mutual fund SEBI keeps a very tight check on these mutual funds, so that the public money is not being misused, right? So that it is being invested in the right way. It is being invested for the purpose for which it has been taken from the public. So I can say mutual fund industry in India are well regulated. Tax benefits. So in India, there are a lot of tax benefits if you invest through mutual funds, or if you invest in the equity funds and the debt funds and ELSS, equity linked savings scheme. There are a lot of tax benefits. Again, I will be talking this point later on in my discussion. So there are tax benefits of investing in the mutual funds. So how the mutual funds working of the mutual fund, right? So as in the beginning I said, there is investors, large number of investors who want to invest. I said in the beginning that there are almost 12 crore folios exist in. Folios means accounts, right? So different investors invest in different schemes of the mutual funds. So these investors pool their money, give the money to the fund manager or the company, right? And these fund managers invest in securities. They do research, invest in securities, invest in assets, invest in different class of debt, right? And with this investment, they generate income, right? In form of capital appreciation and in form of regular income. It may be both, it may be one of them, right? And thereby getting return for the investors. And this return is passed back to the investor. So they take money from the investors, generate income for the investors, and give back to the investors. So you may be thinking that is always every investment is subject to risk, friends. I mean, suppose the asset in which the professional managers or the fund houses are invested, these investments are subject to market risks. If I talk of the equity schemes, where the mutual fund house invest in equities, shares, I can say, in common parlance, right? So if the stock market falls because of any reason, because of it may be geopolitical reason, it may be political uncertainty in the country, it may be the good or the bad shape of the economy. If there is a large scale of fluctuations in the stock market, certainly the return of the mutual fund house will also fluctuate, because where they have invested in the stock market. Since if I am talking of the equity mutual funds, right? So equity mutual funds invest in equity shares. If the investment in the equity shares is there, the value of the asset that the mutual fund house has invested, it depends on the fluctuations in the market. If market falls, then the value of the investment will also fall, right? The degree of the fall may vary, means the degree of fall may be less than the fall in the stock market, because if mutual fund manager is a very smart person, and because of the smartness means in terms of the professionalism, he or she might have invested in such assets, such shares, where the fall is less affected as compared to the fall in the Sensex or the Nifty, right? Nifty or the Sensex. So certainly the fall will be less. And when the stock market rises, the increase in the value of the shares may be larger than the increase in the percentage of Sensex or the Nifty, right? Means we call it in the common parlance, the mutual fund house may outperform the market, right? So outperform, if it increases, they earn more than what the market has earned, right? If it falls, the decline in the value of their shares is less as compared to the fall in the Sensex or the Nifty. What I mean to say by this is that every investment is subject to risk. So is the investment of the mutual funds. Don't take the impression that when you invest in the mutual fund, there is always income, right? There will be income, but in the long run. Short run, there may be a fall, temporary fall. So there may be notional loss also. So very quickly, this is more of academic interest, how the mutual fund industry in India has evolved over a period of time, right? So beginning in the 1964, the Unit Trust of India was established in 1963 by an act of parliament, right? So the Unit Trust of India, is the first mutual fund to operate in India, right? So UTI had monopoly till 1987. So right from 1963 or 64 up to 87, it was the only mutual fund house in India. After that, the public sector mutual funds entered in 1987. So SBI was the first non-UTI funds. And friends, still in India, if you ask me which is the largest mutual fund house in India, I would say the State Bank of India or the SBI mutual fund is the largest mutual fund in the country. So it is a second mutual fund in India which started, that is also in the public sector. Then comes a phase 1993 to 2003. Public sector fund enters in 1990. Private sector funds entered in 1993, right? So means first private sector mutual fund came to India in 1993. Or when I say came to India means which was started in India, government of India allowed the private sector to enter the mutual fund industry first time in 1993. So this was the first erstwhile Kothari Pioneer. This Kothari Pioneer was the first private sector mutual fund in India. This is no longer, Kothari Pioneer. This has been taken over by the Franklin Blue Chip Fund, right? So this Kothari Pioneer was taken over by Franklin, right? So erstwhile Kothari Pioneer was the first private sector mutual fund registered in July 1993. So it's the first mutual fund regulation came into 1993, right? Then comes the era from 2003 at present. So in February 2003, following the repeal of the Unit Trust of India Act 1963, UTI was bifurcated into two separate entities. So merger started taking place among different private sector funds, right? So friends, this is how mutual fund industry in India has evolved. And as I was saying in the beginning, today the mutual fund industry is growing at a very fast rate. And I can say with a proud that Indian mutual fund industry is a mature industry at present. It is growing fast. It has more than 12 crore accounts. It has asset worth 39 lakh crore rupees worth of asset it is managing. Means the financial assets or the assets of approximately 39 lakh crore rupees is managed by the mutual fund industry in India. So friends, I'm stopping here. So for this lecture, and I'll be again continuing with this mutual fund in India in my next lecture. Thank you very much.